Okay. Now let's try to understand the concepts of ratio analysis and why these are used. So let's take the example of one company whose name is Apple Incorporation. Now Apple company, let's suppose, is having $100 of revenue. I am taking very simple and easy example, and net income of $25, and equity shareholders are investing $50 in the company. Now the company's net profit margin is, someone asks, you will simply say $25 is earned from $100 of sales, so the net profit margin is 25%. Similarly, if the people ask that how much people have earned, or the equity owners have earned through investing $50, so you will be saying they have earned $25 by investing $50, to which we call return on equity, like 50% here. Similarly, if we take another example, like for Microsoft Corporation, so Microsoft is having their current assets of $200 and current liabilities of $100, meaning they are having cash, inventories, debtors, and other items worth $200, and liabilities like creditors, accounts payable, or other liabilities in the terms of $100. Now, if someone asks how they are performing, so you will be saying that if today any of their creditor or all of their liability needs to be discharged, can they do that? You can say yes, they can do that. There is a good probability because they are having good amount of current assets worth $200. So we call that as current ratio, which simply says 200 divided by 100, which gives us 2. Similarly, if we go ahead and see the Tesla Incorporation's example, so let's suppose Tesla is having the debt, or I can say debentures, in their books of accounts for $20 and equity for $80. Now they are having earning before interest and tax of $40 and interest expense of $2. So what you will say, how is the composition of the company's structure? So you will be saying company has taken $20 of debt and $80 of equity. So basically, if in future there is a problem with the company's inflow, company is not earning well, then do they need to pay equity holders the interest? They don't need to pay the interest to equity holders. But do they need to pay the interest to debt holders? You will be saying yes, they will need to pay the interest to debenture holders. Why? Because these are fixed commitment and these are not fixed commitment. So if one ratio is calculated just like debt to equity ratio, which simply says that company is having 20 debt and 80 equity, meaning 0.25, it simply means that company is having low fixed commitments within them. If we go ahead and try to see that, okay, the company needs to pay interest of $2 and they are having earnings of $40 available with them, so can they pay interest of $2? Are they at any risk? You will be saying yes, they are not at any risk, because their interest coverage ratio is 20 times. How 20 times? Because they are having $40 of money or earning before interest and tax available, and interest is only $2 here, making it to $20. Let's take another and the last example of Walmart Incorporation. Now Walmart is having the revenue of $300 and cost of goods of $240. They are having inventory of $30 and total assets of $100. Now if someone asks you that how many times inventory is being sold by Walmart throughout a year, so you will simply say that, okay, at a time, at a single point of time, they have inventory of $30, and in the entire year they have sold $240 worth of cost of goods. So around I can say uh, 8 times. When you say 240 divided by 30, meaning 8 times they sell in the company, right? Why 8 times? Because inventory is hold for $30, then again I can say they sell it, again they hold $30, again they sell it, again they hold $30, and throughout the year they have sold $240 worth of cost of goods sold. So this is the inventory turnover ratio. Similarly, if someone asks you how efficiently they are using their assets, so you can say they are having assets of $150, but out of that asset, from that asset, they are generating revenue of $300. Here $300 of revenue is generated from $150 of assets. So basically they are generating 2 times of their assets, which is also a good sign. So in reality what happens, there are a lot of companies across world wherein we need to analyze different kind of situation for them, how they are performing, whether they are doing good or not. So let's see the textbook concept for ratio analysis. So basically ratio analysis simply tells about simplifying the numbers from financial statement and show the important relationship between them. They also tell how the company is performing, just like we saw in case of Walmart that the asset turnover is good, they are performing well. And the comparison can be done in two ways. First is over a time, that in any company what happened in 2025 versus 2026. Similarly, the comparison can be done with other competitors, just like how Amazon is doing versus how other competitors of it are doing, like how Amazon is doing, how eBay is doing, or how I can say other Flipkart or other companies are doing. So competitor benchmarking can also be done. Similarly, these help the investors, lenders and management to also make the decisions, because investors plan whether they should invest in a good company, so they need to check it. Lenders need to see whether they will be getting their money back, whether they will be able to receive the interest back, they will be checking it. And managers also needs to think and see how the business is performing. Now mainly there are four types of ratio in a company, and one ratio is known as profitability ratio, wherein simply we try to evaluate our profits. Next are the liquidity ratios, that how much money in terms of liquidity company is having, so that they can pay their short term commitments. Third ratio which they have is the solvency ratio, which is like, can we pay our long term debts, can we pay our long term commitments. So liquidity and solvency have one difference. Liquidity is simply short term and solvency is simply long term. Now the performance and efficiency ratios are also there, that how efficiently the company is able to utilize their resources or assets. Now using these resources we can understand if the company is growing, stable or needs certain improvements.